Now this has become a battle between too much and not enough. Now, as Egon von Greyerz of Matterhorn Asset Management pointed out recently, quite rightly, central bank balance sheets are absolutely exploding, and the strong likelihood is that this can only end in one way, and that's massive inflation. Yes, maybe we have to suffer through a deflationary environment for a brief period, but believe me, it will always end in inflation because that's the medicine that the Fed and other central banks use to treat the disease. As Warren Buffett pointed out several years ago, there really isn't that much gold in the world. Warren used a 67-foot cube as his example, others used 2 Olympic-sized swimming pools. Either way, the point remains. The more too much is increased, the more severe not enough becomes. The central banks are in effect trapped. Now, global debt has been growing steadily for decades, but since 2001, it too has exploded as Western countries have borrowed money at a blistering pace, fueled by record low interest rates. Global debt is up 28% in the last 2 years, and 250% in the last 10 years, and all of that expansion has come from the West. The central banks of the US, Europe and Japan have increased their assets, and I use that term under advisement, by a massive 32% in the last 17 months. And they show absolutely no signs of slowing down. And for what it's worth, Switzerland and the UK are not far off that pace. My good friends at QB Asset Management in New York, Paul Brodsky and Lee Quaintance, put this debt into perspective last year in a table they included in a piece they wrote called Apropos of Everything. And again, you should Google that, read it. It's really required reading in my opinion. The top row in this table shows US monetary base, which has almost doubled from 1994 to 2006, and then quantitative easing increased it substantially in the last few years. The second row shows that the Fed would have to manufacture about 5 times more dollars than exist today, merely for the Treasury to be able to meet their obligations. Now in the bottom row you see a figure of $70 trillion, and that's a conservative estimate of total dollar-denominated claims. Others have used over 100 trillion. Now these claims include Treasury debt, other unfunded federal obligations, as well as mortgage, auto, consumer, corporate, state and municipal debt. 70 trillion in dollar-denominated debt on top of 2.7 trillion in currency and bank reserves with which to repay it means the US economy is levered roughly 26 to 1, which is Lehman levels. Now traditionally the overhang of central bank gold sales has been touted as a reason for downward pressure on the gold price. But if we take a look at this argument in detail, we find that not only does it not really stand close scrutiny, but that now, with central banks becoming net buyers of gold, the central banks themselves provide a powerful tailwind to the gold price. This chart of official gold holdings of central banks going all the way back to the mid-1960s, when of course the gold price was fixed, is quite telling. It shows that through the first great bull market of the 1970s, concerted central bank selling was still not enough to stop gold rising from $35 to $800. Without that central bank selling, who knows where gold may have traded. It's also very important to know that in the 1970s there really were no Asian buyers of gold. The Asians didn't really have the money back then that they had now. After the inevitable correction after that huge spike, gold traded sideways for about 20 years, during which time a further 110 million ounces of central bank gold sales were just soaked up. The signing of the Washington Agreement in September 1999 limited central bank gold sales to 400 tons over the next 5 years. This agreement was renewed again in 2004 and once more in 2009, although this last time the IMF stayed out of it. As central bank gold holdings hit their all-time low of 958 million ounces in March 2009, the price of gold, which was driven largely by inflationary concerns in the wake of the Fed's massive monetization post the global financial crisis, had reached $1,100. That's a 4-fold increase from its 2002 low. A constant feature of the rise to those levels were warnings about impending sales by the IMF or a central bank that would cap the gold price and potentially drive it down. Looking at it now, it's hard to believe how many people were concerned about such an eventuality. It shows just how short-term the collective view is. In March 2009, central banks performed an abrupt U-turn and began buying gold once again, clearly having decided that gold was reassuringly expensive enough to make such an action prudent, and predictably, the presence of captive and largely price-insensitive buyers in the market changed the trajectory of gold once again. As you can see, the price rise just got steeper there on the right-hand side of the chart. Staying on the not enough side of the equation, this chart shows Western central bank gold reserves. Despite their consistent selling in previous years, the level of gold backing the major Western economies is still pretty significant. You remember the calls for Italy to sell some of their gold to try and repay some of their debts when Italy first became wrapped in the crosshairs of the pigs debacle. But these reserves have been declining steadily, not necessarily through sales of gold, but through the huge increase in the relative monetary basis as a result of the various quantitative easing processes. The US had over 83% coverage just a handful of years ago, but the dramatic expansion in their monetary base has meant that level of coverage has shrunk significantly. But what of the BRICS? Or in this case, the RICS: Russia, India and China. Russia's central bank has not only been a consistent buyer of gold in the last 5 years, but they've also been very transparent about how much and when they've been buying. They announce the numbers every month. They're released on this Russian central bank website. As you can see from this chart, they show no signs of slowing down either. Russia is the world's 5th largest producer of gold, and it now exports precisely 0 ounces of gold. How much of that gold ends up in the central bank's coffers, though, is not in the public domain. It's a similar story with India. India's central bank is another buyer of gold. Now, as the chart comes in, you can see a big spike in 2009, and that was generated by the purchase of 200 tons of gold directly from the IMF. Rumour has it that Eric Sprott actually bid the IMF directly for that 200 tons of gold, but they refused to sell it to him. The Indians have confirmed they will be looking to add to their reserves in the coming years. And then there is China. Now, this is where things get very, very interesting. When China told the world in 2009 that their gold reserves have virtually doubled to 1,054 tons, the world was shocked. I don't include the guys at GATA into that grouping. Bill Murphy and I were chatting about this earlier on, and Bill was anything but shocked. But to put that into perspective, that's about 20% less than the GLD ETF currently holds. The numbers for 2010 and 2011 are even more interesting, because we have absolutely no idea what they are. None. And believe me, China is not about to tell us. What we do know, though, is this. Number one, China is now the world's biggest producer of gold, with roughly 350 tons of annual mine production. Number two, since 2009, China, like Russia, has not exported a single ounce of gold, and that will not be changing, certainly not in my lifetime. And number three, also in 2009, China cleared the way for its citizens to privately own gold, and that is now both positively and actively encouraged by the government. You see ads everywhere encouraging people to buy gold, buy silver. What we don't know is how much of this domestic mine production, again, is finding its way into the central bank vaults, or how much gold is actually being bought by Chinese citizens. But I can tell you from my perch in Asia, both these numbers are most likely a lot higher than even the most bullish estimates. Anecdotally, the evidence is everywhere you look amongst the bullion dealers in Singapore and Hong Kong. Lengthy delivery delays and spectacular demand increases monthly. And every conversation you have with traders or custodians, there are huge demand on storage facilities at the bullion storages, and people requiring space now, it's just getting to astronomical levels. But there's one official release we can use to try and gauge the flow of gold into China, and that's the official imports of gold from Hong Kong, which is actually reported monthly and officially. Now, this chart speaks for itself. Since 2009, imports have increased tenfold, with December 2011's imports alone a staggering 102,000 kilograms. China is swapping its paper for gold as fast as it possibly can, and the reason why is obvious. She doesn't have enough. Now, you remember these numbers from a few slides ago. We're going to put them up here again just by way of perspective. But if we look at the comparable figures from both India and Russia, they're pretty striking. Despite their aggressive buying, both countries' reserves of gold remain below 10%. And then, again, there's our friends in China. China's reserves, as at 2009, remember, constituted roughly 1.8% of their returns. That's 1.8%. Let's do some math around that, shall we? Here's a look at world gold production in 2010. Now, 10% of China's reserves would equal 5,855 tons of gold. Now, we know that all of China's gold production is staying in China, so let's suppose, for the sake of this argument, that every ounce mined goes directly into the central bank's coffers. We already know that Russia's 190 tons is off the market, so that leaves China with around 1,400 tons of gold amongst the 7 countries on this list. Let's assume, for argument's sake, they somehow managed to buy 1 out of every 2 ounces mined by each of the other countries on this list. Now, I know that's virtually impossible, but I don't want anyone to be able to accuse me of stacking the deck. We add China's existing gold of 1,054 tons, and we get 1,769 tonnes, which leaves them a shortfall to get to 10% of their reserves of 4,086 tonnes. Now, as you can see, even from this wildly optimistic math, China absolutely cannot buy enough gold to meet her demand. Not at these prices anyway. But what is the right price for gold in a fiat world? Well, ultimately, there's only one way we're all going to find out. But in the meantime, my friends at QB have taken a stab at doing the math for the United States, which is a sensible enough place to start, let's face it. And the results are interesting to say the least. This is another familiar chart, the US adjusted monetary base. Now, as you can see, since 2008, it's absolutely gone nuts. Now, by dividing the monetary base by official gold holdings, which is incidentally the same method used in Bretton Woods, which resulted in a price of $35, Paul and Lee came up with what they call their shadow gold price. And the results show just how drastic the devaluation of the dollar has been. As you can see here, where we stand now, to back the currency to gold price should be $9,943. Now, the numbers to the right of their flat number assume differing monetary base growth rates going forward, and the numbers are absolutely eye-watering. It's highly unlikely we'll get that far, but it's worth pointing them out. So what does this all boil down to? Ultimately, it boils down to control. There's a silent battle going on for the control of the world's gold supply. The West has it, the East wants it. The East has the money, the West doesn't. The Western public doesn't understand this. The Eastern public has the ownership of gold embedded in their DNA. Only now, along with that understanding, they also have the money. And we looked at the disparity between gold reserves in developing and developed nations earlier on, but here's one more chart on the subject to take away with you. These are the top 10 holders of gold in the world by tonnage. Actually, there are 11 bars here. The farthest left is the combined EU holdings, which total roughly 10,000 tonnes. But you'll notice an empty slot at the far right. Now, does anybody want to guess which group this bar represents? It's Indian households, private ownership of gold in India, which represents 18,000 tonnes. Or, to put it into perspective, the same amount as the central banks of the European Union and the USA combined. Now, we're going to wrap things up with the thoughts of one of the speakers here this weekend, a man whose work on gold has been absolutely outstanding for many, many years, John Embry. Now, John wrote a piece entitled 15 Reasons to Own Gold, and I've picked out 7 of them to share with you today. Rapidly expanding global money supply, expanding central bank balance sheets, ubiquitous money printing and the race to debase all these currencies to their lowest possible level, negative real interest rates, central banks soon to stop supplying gold to the market, increased investment demand and geopolitical tensions. Now, many of us here are familiar with these reasons, which in essence form the core rationale for holding gold. But here's the catch. John wrote this piece in 2003. That's 9 years and about $1,400 ago. They're as applicable today as they were 9 years ago. Nothing has changed, unless of course you count the fact that central banks have stopped supplying gold and have actually started to buy it. Things are, in fact, worse. So how will we know when our long-term trade is done? What are the signs going to be that it's time to find the next big idea? Well, here are 5 key things to look for as signs that the great bull market is coming to a close. Interest rates will begin to rise meaningfully. Central bank monetary policy is going to change. The central banks will stop buying gold. Gold stocks, which are trading currently at ridiculously undervalued levels, will trade at severely overvalued levels, like the Nasdaq stocks did at the end of the tech bubble. And collapses will become corrections. And by that, this is just pure psychology. When everybody's invested in something and that something comes off in price, it becomes a correction. If nobody has it, it becomes a collapse. Right now, we're in the collapse phase. When everybody's long gold, every time it comes off a little bit, it's going to be called a correction, not a collapse, believe me. But I promised you simplicity today. So that's what I'm going to give you. We're going to boil this down. We're going to reduce this list of 5 to one simple indicator. That's going to be the sign that it's time to move trades. And that's this one. Central bank monetary policy is going to have to change. And I don't think that's going to happen for some considerable amount of time. Until this common policy of competitive debasement by central banks changes, this gold bull market has a lot further to run. Simple. Thank you very much.